Chapter 3. In this chapter, we are going to discuss these topics. Balance sheet. Balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholders' equity at a specific point in time. It gives us the formula that total assets equals total liabilities plus shareholders' equity. Income statement. Income statement is a financial statement measures a company's financial performance over a specific period. It indicates how the revenues are transformed into the net income. The financial statements we just mentioned are expressed in raw dollar amount. They may not provide clear information for some uses, such as intercompany comparisons. So, an alternative reporting format, common size financial statements, is used, where every item is expressed as a percentage of a common item. For example, we can express every item in the balance sheet as a percentage of total assets, and the balance sheet formatted in this way is called a common size balance sheet. Similarly, we can express every item in the income statement as a percentage of net sales, and the income statement formatted in this way is called a common size income statement. Statement of cash flows. Statement of cash flows is a financial statement provides a complete indication of the sources and uses of a firm's cash resources over time. Statement of cash flows shows how changes in balance sheet account and income affect cash and cash equivalents. It breaks the analysis down to operating, investing, and financing activities. It can be prepared by using direct method or indirect method. By using direct method, the company reports cash receipts and cash disbursements from operating, investing, and financing activities. For each activity, net cash is obtained by the difference between cash receipts and cash disbursements. Net change in cash is the sum of net cash from operating activities, investing activities, and financing activities. This slide provides an example of statement of cash flows using direct method. We see that net change in cash is the sum of net cash from operating activities, investing activities, and financing activities. By using indirect method, the company starts with net income and converts it to net cash flow from operating activities, which requires adding back non-cash expenses including depreciation, amortization, and deferred taxes, and making adjustment from changes in beginning and ending balances of current assets, current liabilities, and sometimes long-term assets. The company obtains net cash flows from investing activities and financing activities. Summing up net cash flows from operating activities, investing activities, and financing activities yields the net change in cash. The reasoning of computing common size financial statements extends to the financial analysis. Ratios standardize various elements of financial data for differences in the size of a series of financial data. So, Financial ratios are used when making comparisons over time or between firms. Recall from Chapter 1. Each group of stakeholders has their own respective concern. Suppliers may be concerned about a firm's current liquidity or near-term cash-generating capability. Bondholders may be concerned about a firm's cash-generating capability over the long run. Shareholders may be concerned about a firm's profitability. There is no single ratio that can answer various concerns. We next discuss 6 different groups of ratios developed to help stakeholders assess their concerns. Liquidity ratios. Liquidity ratios indicate a firm's ability to meet short-term financial obligations. Asset management ratios. Asset management ratios indicate a firm's efficiency of managing assets, that is, how efficiently a firm uses assets to generate sales. Financial leverage management ratios. Financial leverage management ratios indicate a firm's capacity to meet both short-term and long-term financial obligations. Profitability ratios. Profitability ratios indicate a firm's overall performance. It shows how effectively a firm generates profits on sales, assets, and stockholders' equity. Market-based ratios. Market-based ratios indicate financial markets' evaluation of a firm's performance. Dividend policy ratios. Dividend policy ratios indicate a firm's dividend practices. Liquidity ratios. Liquidity ratios indicate how well a firm can meet its short-term financial obligations. We will look at current ratio and quick ratio. Current ratio. Current ratio is defined as current assets divided by current liabilities. It shows a firm's ability to pay back the short-term liabilities with the short-term assets. You don't want the current ratio to be less than 1. Why? Let's look at next slide. If current ratio is less than 1, by definition, it means current assets divided by current liabilities is less than 1. Multiplying both sides by current liabilities, we obtain current assets are less than current liabilities. That is, the company does not have sufficient current assets to back up its short-term financial obligations. Current ratio measures a firm's ability to pay back the short-term liabilities with current assets. Current assets include cash, cash equivalent securities, accounts receivable, and inventories. We may have doubts about the liquidity of some current assets, so there is another more stringent ratio where the least liquid asset among current assets, inventories, is taken out to measure a firm's ability to pay back the short-term liabilities. The ratio is called quick ratio. It is also known as acid test. It indicates a firm's ability to pay back the short-term liabilities with the most liquid short-term assets. There is still one crucial assumption of using quick ratio, that is, accounts receivable can be converted into cash within the normal collection period or within the granted credit period. What if you have doubts about the liquidity of accounts receivable? Then you can use agent schedule to make a further analysis. Aging schedule. Aging schedule is a table of accounts receivable broken down by the days until due or the days past due. By definition, the numerator in the current ratio is larger than the numerator in the quick ratio by the amount of inventories if the amount of inventories is not equal to 0. Therefore, current ratio is always greater than or equal to quick ratio. Asset management ratios. Asset management ratios indicate a firm's efficiency of managing assets, that is, how efficiently a firm uses assets to generate sales. We will look at average collection period, inventory turnover ratio, fixed asset turnover ratio, and total asset turnover ratio. Average collection period. Average collection period is defined as accounts receivable divided by daily credit sales. It indicates the average number of days an accounts receivable remains outstanding. How do you want to use it? You may compare average collection period with a firm's credit policy. If a firm's average collection period is significantly longer than the credit period granted to customers, it may signal a collection problem for the firm. You may also compare it with the industry norm. If a firm's average collection period is substantially above industry norm, it may indicate a firm's credit policy is too liberal. That is, the potential incremental cost from bad debts may eventually hurt a firm. If a firm's average collection period is far below the industry norm, it may indicate a firm's credit terms are too stringent and are hurting sales by restricting credit to the very best customers. Inventory turnover ratio. Inventory turnover is defined as cost of sales divided by average inventory. It indicates the efficiency of a firm in managing and selling inventory. Fixed asset turnover ratio. Fixed asset turnover is defined as sales divided by net fixed assets. It indicates how efficiently a firm uses fixed assets to generate sales. It should be used as year-to-year comparisons within the same company rather than for intercompany comparison. Total asset turnover ratio. Total asset turnover is defined as sales divided by total assets. It indicates how efficiently a firm uses total assets to generate sales. By definition, a low total asset turnover ratio may indicate low in sales and or high in total assets. If the low total asset turnover is driven by low in sales, a firm may want to find out the reason. Is it driven by sluggish sales? If the low total asset turnover ratio is driven by high in assets, a firm may want to find out the reason. Is it driven by the fact that the firm is carrying too much production capacity? Is it driven by the fact that the firm is undergoing modernization expansion? Creditors care about a firm's financial leverage ratio. Why? Because A firm with low debt financing offers more protection to its creditors in the event of bankruptcy. Financial leverage management ratios. Financial leverage management ratios indicate a firm's capacity to meet both short-term and long-term financial obligations. We will look at debt ratio, debt to equity ratio, times interest earned ratio, also known as interest coverage, and fixed charge coverage ratio. Debt ratio. Debt ratio is defined as total debt divided by total assets. It indicates how much debt a company is using to finance its assets. Debt to equity ratio. Debt to equity is defined as total debt divided by total equity. It indicates how much debt a company is using to finance its assets relative to the value of shareholders' equity. Times interest earned ratio, interest coverage. Times interest earned ratio is defined as earnings before interest and taxes divided by interest charges. If times interest earned ratio is less than 1, it means earnings before interest and taxes are less than interest charges. That is, a firm does not generate sufficient earnings to honor its interest charges. Fixed charge coverage ratio. The formula for fixed charge coverage ratio is provided here. It shows a firm's ability to honor its fixed charges. If times interest earned ratio is less than 1, by definition, it means earnings before interest and taxes divided by interest charges is less than 1. Multiplying both sides by interest charges, we obtain earnings before interest and taxes are less than interest charges. That is, the company does not generate sufficient earnings to honor its interest charges. Profitability ratios. Profitability ratios indicate how effectively a firm generates profits on sales, assets, and shareholders' equity. Anyone whose economic interests tied to long-run survival of a firm will be concerned about profitability ratios. We will look at gross profit margin ratio, net profit margin ratio, return on investment, and return on shareholders' equity. Gross profit margin. Gross profit margin is defined as sales less cost of sales divided by sales. Net profit margin. Net profit margin is defined as earnings after taxes divided by sales. Return on investment. Return on investment is defined as earnings after taxes divided by total assets. It is the amount of net income expressed as a percentage of total assets. It indicates how efficient management is at using assets to generate earnings. Return on shareholders' equity. Return on shareholders' equity is defined as earnings after taxes divided by shareholders' equity. It is the amount of net income expressed as a percentage of shareholders' equity. It shows how much profit a company generates with the money shareholders have invested. Return on investment is defined as earnings after taxes divided by total assets. we can disaggregate it into the product of earnings after taxes divided by sales and sales divided by total assets. Earnings after taxes divided by sales, by definition, is net profit margin. Sales divided by total assets, by definition, is total asset turnover. So we can express return on investment as the product of net profit margin and total asset turnover. This disaggregation has the benefit to identify how a firm achieves the return on investment. Return on shareholders' equity is defined as earnings after taxes divided by shareholders' equity. We can disaggregate it into the product of earnings after taxes divided by sales, sales divided by total assets, and total assets divided by shareholders' equity. Earnings after taxes divided by sales, by definition, is net profit margin. Sales divided by total assets, by definition, is total asset turnover. Total assets divided by shareholders' equity, by definition, is equity multiplier. So we can express return on shareholders' equity as the product of net profit margin, total asset turnover, and equity multiplier. Moreover, the product of net profit margin and total asset turnover is return on investment. So we can also express return on shareholders' equity as the product of return on investment and equity multiplier. This disaggregation has the benefit to identify how a firm achieves the return on shareholders' equity. Debt ratio is defined as total debt divided by total assets. Equity multiplier is defined as total assets divided by shareholders' equity. We also have the accounting identity. Total assets equal total debt plus shareholders' equity. Dividing both sides by total assets, we arrive at this equation. We have total assets divided by total assets equal to 1. Total debt divided by total assets, by definition, is debt ratio. Stockholders' equity divided by total assets, by definition, is the inverse of equity multiplier. So we have the equation 1 equals debt ratio plus the inverse of equity multiplier. Subtracting both sides by the inverse of equity multiplier, we arrive at 1 minus the inverse of equity multiplier equals debt ratio. We observe that the larger the equity multiplier, the smaller the inverse of the equity multiplier. Therefore, the larger the difference between 1 and the inverse of the equity multiplier, that is, the larger the debt ratio. So we have the relationship: the larger the equity multiplier, the larger the debt ratio. What is the return on stockholders' equity for a firm with a net profit margin of 5.2%, sales of $620,000, an equity multiplier of 1.8, and total assets of $380,000? Return on stockholders' equity is defined as earnings after taxes divided by stockholders' equity, which can also expressed as the product of net profit margin, total asset turnover, and equity multiplier, we have a net profit margin of 5.2%, sales of $620,000, total assets of $380,000, and an equity multiplier of 1.8. After calculation, the return on stockholders' equity is equal to 15.27%. What is the debt ratio of a firm with an equity multiplier of 4.0? From our earlier discussion, we have the formula debt ratio equals 1 minus 1 over equity multiplier. We have an equity multiplier of 4.0. After calculation, we obtain that debt ratio equals 0.75. Market-based ratios. Market-based ratios indicate financial markets' evaluation of a firm's performance. That is, market-based ratios assess a firm's performance from financial market perspective. We will look at price-to-earnings ratio, market price-to-book value ratio, and EV/EBITDA ratio. Price-to-earnings ratio. Price-to-earnings ratio is defined as market price per share divided by current earnings per share. Market price-to-book value ratio. Market price-to-book value ratio is defined as market price per share divided by book value per share. EV/EBITDA ratio. EV/EBITDA ratio is defined as enterprise value divided by earnings before interest, taxes, depreciation, and amortization. Enterprise value is the sum of the market value of common stock, including the market value of preferred stocks if used, plus the market value of debt. One may substitute the market value of debt with the book value of debt. EV/EBITDA ratio is useful in determining acquisition price. Dividend policy ratios. Dividend policy ratios indicate a firm's dividend practices. We will look at payout ratio and dividend yield. Payout ratio is defined as dividends per share divided by earnings per share. It is the proportion of earnings paid out as dividends to shareholders. Dividend yield is defined as expected dividend per share divided by stock price per share. It indicates how much a company pays out in dividends relative to its share price. Dividend yield is one of components of stockholders' return. In Chapter 7, we will show that stockholders' return consists of expected dividend yield and price appreciation yield. Be cautious about a stock with very high dividend yield because it may be caused by a depressed stock price. Financial ratio analysis measures performance at a particular point in time. How do we assess a firm's performance over time? We can use trend analysis. Ratios are only as reliable as the accounting data on which they are based. Ratios look at historical information. Be mindful of the earnings quality and balance sheet quality reported by the firm. High-quality earnings tend to be cash earnings. Earnings management tricks include but not limited to the following. Asset quality issues include charging of assets and hidden assets. Liability quality issues include hidden liabilities. Keep an eye on off-balance sheet financing such as joint ventures, R&D partnerships, operating leases, and so on. Traditional financial analysis lacks tie between performance as measured using financial ratio analysis and shareholder wealth as measured by the market price of a firm's stock. Two alternative measures are introduced to overcome this concern. They are market value added and economic value added. Market value added. Market value added is defined as the difference between market value and the capital invested. It indicates the level of value a company has accumulated over time. It is market's assessment of the accumulated net present value of all of the firm's past and projected investment projects. Market value added measures the amount of wealth generated by the firm since its inception. Economic value added. Economic value added is a measurement of a company's economic success or failure over a period of time. Economic value added is defined as the difference between return on total capital and weighted after-tax cost of capital multiplying capital. Economic value added can be thought as the incremental contribution of a firm's operations to the creation of market value added. Therefore, market value added can be viewed as the present value of all expected future economic value added. If economic value added is positive, it will lead to an increase in market value added. However, positive earnings do not necessarily lead to an increase in market value added. Why? Because positive earnings do not necessarily mean a positive economic value added. Economic value added is positive if the return on total capital is greater than the cost of capital. This slide provides an example showing that positive earnings do not lead to a positive economic value added because return on total capital is less than weighted after-tax cost of capital. This is from the end of chapter question, problem 5. You should be able to calculate total asset turnover, net profit margin, equity multiplier, and return on equity for each firm based on the information provided in the problem. For return on equity, you can calculate it directly by using the definition earnings after taxes divided by stockholders' equity, or you can calculate the return on equity by the product of total asset turnover, net profit margin, and equity multiplier. You will get exactly the same result. We have provided the detailed solutions in the following slides. Let me know if you have any questions. This is a problem from the end of chapter question, question number 17. Please read through the problem by yourself. Now, the sentence. The company has $50 million in 10% debt outstanding means the company currently has $50 million debt with 10% interest rate. Calculate times interest earned ratio. times interest earned ratio is defined as earnings before interest and taxes divided by interest charges. So, we need to have earnings before interest and taxes and interest charges. We can obtain interest charges by the formula. Interest charges are equal to debt amount multiplying interest rate charged by the debt. We have debt amount of $50 million and interest rate of 10%. So, interest charges are $5 million. From problem, we don't have earnings before interest and taxes, but we do have earnings after taxes. We have the formula. Earnings before interest and taxes are equal to earnings before taxes plus interest charges. We also have the formula. Earnings after taxes are equal to earnings before taxes multiplying 1 minus tax rate. Dividing this equation by 1 minus tax rate on both sides, we obtain the formula. Earnings before taxes are equal to earnings after taxes divided by 1 minus tax rate. We have earnings after taxes of $12 million, tax rate of 40%. We therefore obtain earnings before taxes as $20 million. We finally obtain earnings before interest and taxes by the formula. Earnings before interest and taxes are equal to earnings before taxes plus interest charges. From the earlier calculation, we have earnings before taxes of $20 million, interest charges of $5 million. Therefore, we obtain earnings before interest and taxes as $25 million times interest earned ratio is then 5. Find out additional 10% debt that the company can issue now to keep times interest earned ratio at 3.5 or greater. First, find out the total interest payments that the company can afford to keep times interest earned ratio to be at least 3.5 given the current earnings and tax rate. The condition is times interest earned ratio is greater or equal to 3.5. That is, earnings before interest and taxes divided by interest charges is greater or equal to 3.5. We have earnings before interest and taxes of $25 million. So, $25 million divided by interest charges is greater or equal to 3.5. Multiplying both sides by interest charges, we arrive at $25 million are greater or equal to 3.5 multiplying interest charges. Dividing both sides by 3.5, we arrive at interest charges are less than or equal to $25 million divided by 3.5. That is, interest charges are less than or equal to $7.14 million. So, the total interest payments that the company can afford to keep times interest earned ratio to be at least 3.5 given the current earnings and tax rate is $7.14 million. Second, find out the additional interest payment Additional interest payment is defined as the difference between total interest payment and current interest payment. We have total interest payment of $7.14 million and current interest payment of $5 million. So the additional interest payment is $2.14 million. Recall, we have the formula. Interest charges are equal to debt amount multiplying interest rate. That is, debt amount is equal to interest charges divided by interest rate. So, the additional 10% debt is calculated by additional interest payment divided by interest rate. We have additional interest payment of $2.14 million, interest rate of 10%. So, the additional 10% debt is $21.4 million. Additional 12% debt can be calculated similarly. Additional 12% debt is calculated by additional interest payment divided by interest rate. We have additional interest payment of $2.14 million and interest rate of 12%. So the additional 12% debt is $17.83 million. We find that as interest rates increase, the firm's debt capacity decreases. This is an example of using financial leverage to increase return on equity. We solve debt amount using return on equity after borrowing. We need to have earnings after taxes after borrowing and equity after borrowing. Earnings after taxes after borrowing is calculated by earnings before taxes minus interest payment multiplying 1 minus tax rate. Note, earnings before taxes are equal to earnings before interest and taxes for 100% equity financing. Interest payment is calculated by debt amount multiplying interest rate charged by the debt. We have interest rate of 10%, so interest payment is equal to debt amount multiplying 10%. We have the formula earnings before taxes are equal to earnings after taxes divided by 1 minus tax rate. We have earnings after taxes of $9 million, tax rate of 40%. So, earnings before taxes are equal to $15 million. Equity after borrowing is calculated by the difference between original equity and debt amount because debt proceeds are used to retire equity. We have original equity of $100 million. We have all the information needed to calculate return on equity after borrowing. Earnings after taxes after borrowing is calculated by using this formula. We have earnings before taxes equal to $15 million. Interest payment is equal to debt amount times 10%, and we have tax rate equal to 40%. Equity after borrowing is equal to $100 million minus debt amount. We obtain the debt amount equal to $66.67 million.